Good morning. This is Jeff Scott. This is, I believe, the 19th of 2017. It is approximately about 8:40, 8:49 in the morning. Futures are not out, and this is my top-down review. Please note, although I do listen to a lot of other folks, I make these independent. These reflect my words, my thoughts alone. If I ever offend anybody, I apologize in advance. And I don't look at anybody else's market reviews until I've done this, so it doesn't reflect anybody else's thought. I entitled today To Infinity and Beyond. I thought about calling it Avoid Being in Front of Runaway Trains. I did put a question mark there because, there's no question we are in a massive bull. Well, I want to back up. We're in a strong move. I don't want to call it a massive bull market because not everybody or every stock is participating. But if you're in the right sectors, I know where I am for my returns, but 25% returns year to date are possible, and that's, I'm sure people have done even better. But that's what happens when you're in the right sectors, the right industry groups, in a strong market, and that's what HGSI or high growth stock investing is all about. As always, this is for education purposes only. I'm a doctor, not a broker. I am independent. I am as one of the IBD leaders says for their user group, I am an unpaid volunteer, amateur. All the tools I use, I paid for myself. Nobody pays me to say good or bad things about them or others. Trading involves risks. Again, anything I say here should be taken in the spirit of education. When I identify stocks, it is not telling you or suggesting that you go buy the stock. It's rather showing you how I came to that thought process. Any trading decisions you make are yours and yours alone. I think to be safe, I also like to call out that I will often talk about options, and I am a big fan of options, but you need to know how to trade options. Options can be very risky, and I refer you to the Options Industry Council for their wonderful brochures before you trade options. I like to call what I do being your own guru. As my hero, mentor, Ian Woodward once said to me, "Jeffrey, I'm not the guru. I teach you to be your own guru." And I think that's how you have to affect trading. You need to listen and learn, identify who you believe and who you think is FOS, and then build your own style based upon what you take from others and improve upon others. So I started learning canceling by O'Neill. I think Morales and Catcher have certainly added steroids to the mix, adding things like pocket pivots, Bible gap ups, a punch bowl of death. They also came up with a great shorting book, which may become useful soon. And then you have Ian Woodward and Ron Brown. Ian grew up listening to O'Neill on the radio, grew up in investing, and worked with a guy named George Roberts with highgrowthstock.com and automated, or at least made electronic and automated with a punch of a button, many of the tricks and strengths of canceling, and then added his own colorful named indicators. So a lot of the names that I use that are novel to you, like Eurekas and Phoenixes and Bongos and Bingos, Kahunas, these all came from the lips of Ian Woodward. Over on the right is my other mentor, and someone that I think very highly of today, and that's John Person. And John is a trader, mentor, friend, author, developer of indicators, puts on great educational programs. These are two of his great books. And John really is, to me, is the practical trader in that he has some very clear-cut buy and sell signals, very good trader. His signals, especially his scanners and his charting indicators, are things that have made me a lot of money and I use every day. Van Tharp, Position Size Money Management, the Bible, and then my buddy George Lee, who I have the opportunity of once again hopefully sharing the podium with, in the next month or so. I have lots of different tools. I think I hid my desktop. I do it intentionally. I don't need them all. If you give me TradeStation and Thinkorswim, I'm getting to the point where I've duplicated most of what I do in one and the other, but I still like to have both. Genesis is a nice option. It's a nice to have, not need to have. And then for analysis perspective, HGSI and EdgeRater, websites, and then seasonality. Here's highgrowstock.com. I put it here just because if you're new to me and you want to use the tool that I will be using for most of my discussion, there's nothing that I do. There may be a few tweaks, but they're not secret tweaks. Everything I do is built in and comes out of the box. You click here, you get a free 30-day trial. You click under investing strategies, you'll see my name. You'll also see Ron Brown. I do these on a weekly basis. Ron has shorter but very frequent videos where he looks at how he uses HGSI, and he has a different approach to the market. We find a lot of the same stocks where I'm looking a lot at pivots and person signals combined with my top-down approach. He's combining a top-down approach with volume price analysis, and he's got a lot of fans. The other thing to point out is the 30-day trial truly is 3. They don't even ask you for a credit card. Upcoming live events, this is new. George Lee has started circulating that he's holding his next Southern California meeting. He does these at the Santa Ana Holiday Inn. Holiday Inn is clean, it's reasonable. There are lots of other hotels if you don't want to stay at the Holiday Inn in the area. It is a little later this year, March 25th to March 27th. And there's Greg's email address. I will be speaking there, as well as Dave, and a few others that have spoken in the past. And I'm sure Chris White from EdgeRater will be there. I am scheduling, once Greg has indicated that he has enough interest, I will schedule a pre-meeting. Now, the 25th, the meeting starts actually at 6 p.m. on Saturday. It's a little different this year. So a couple hours on Saturday for intro. Sunday will be an all-day meeting. And then Monday we'll trade live during the market and still have plenty of time to fly out of John Wayne Airport to come back east before the red eye. So once Greg has solidified the meeting, which will be based upon getting a minimum number of attendees, then if there's interest, I will hold a pre-meeting. When I do a pre-meeting, I will start in the morning on Saturday, on Friday, and go through the basics of what I do, how I do it, why I do it, what these indicators mean, how I use Thinkorswim TradeStation to make money, and then get advanced for half a day on Saturday. So Friday will be the intro and basics and intermediate, and then Saturday will be advanced. I'll talk about some of my favorite ways of using options. And again, if you have interest in that, I'm not asking for money. I won't know how much it costs until I see what the interest is. It'll be probably for the 1.5 day meeting. For me, it'll probably be 600 or 700 because I'm not going to have the volume that Greg will have, and Greg will probably be in the 300 or 400 range typically, although there's been some talk of increasing that and providing food. And then also letting you know that John Person has announced his meeting in Vegas in May. I will be attending, at this point probably not speaking, but I'm always willing to do a pre-meeting or a post-meeting if there's enough interest. So, back to this picture again, which I always have to think about, and so do you, of where are we? And boy, the minute we think we're rolling over, we start back another up leg. That's what bull markets do. They pause to refresh, they give you some bull flags, and then once you think it's time to get out, they run again. And we're running again. The issue is, when are we going to get up here on this shoulder here? And I'm not talking head and neck, I'm just calling that a shoulder, and head and shoulders rather. And when are we going to not break out to higher highs, but come back down and test some lows? It's going to happen. I guarantee it. No one knows when. The pundits on TV don't know. I don't know. But markets don't go up forever. And we know feds are raising rates. There continues to be all kinds of concerns coming out of this administration. So eventually the market's going to correct. I've made many mistakes in the past, and one of the mistakes I typically make is getting out in front and trying to call it. Sometimes I get lucky. I had a great trade this week on SVXY, probably the highest return on investment on an annualized basis in my life. But it was just because it was a super setup. I was in the trade for 12 hours, and those who've been here before know that I'm not a day trader. But that's what I had to do if I went to the short side. Based upon where you think the market is, you have to adjust what your trades are. So yes, I think we're over here on the left. I think it's time to still be buying, at least in the right industry groups. But the risk every day that we go up, I think the risk gets higher because we're just one more day closer to that ultimate correction. So what does that mean? It means that covered calls or selling premium may be out of the money on some of my positions. Why not? If the stock market goes up, I may lose my position, but I lose it at a higher price than selling it today, and I put some premium in my pocket, which would blunt any short-term fall. I might sell puts that are out of the money, hoping that my stock either doesn't go down there, or the stock I'm selling the put on doesn't go there, so I pocket the money. Or maybe I want Amazon at 800, and I'm willing to put some money in my pocket and know that if Amazon falls below 800, I can buy it at a $40 discount to where it's at today. I'm doing that trade not because I want to get the stock, because the stock could be 700 and I get stuck with it at 800. I'm doing because it's a low risk trade and I'm putting the premium in my pocket. Buying calls and selling puts still make sense in this part of the market, but with the VIX so low, premium's quite small, and buying stocks, well, that's been working well. And again, as the cycle of the market changes, my approach will change with it. So I always look at the status of the markets on Friday. Just it's one of the prep things that I do before I do this webinar. And I added the NASDAQ 100. So as I look at it, and I look at the number of green versus red in the NASDAQ 100, I mean, it's pretty clear to me that this is not wasn't a rip-roaring strong day, but on the same token, it wasn't a rip-roaring weak day. That you have mixed behavior. You've got strength in technology, staples, discretionary, retail, utilities, and you got weakness in all of those. It's a very mixed day. You got from 390 to 425, so you've got 35 NASDAQ 100s down, 65 up. And it was a positive day for me. I made some good money on it, but you know, you're looking at this, it looks like it was kind of a mixed day in a uptrending market. If we take a quick look at where the markets are, you can see on the daily. And then for the next two slides, this is weekly, the next one will be monthly. I've got my E-minis in the upper left, NASDAQ futures, which is the NASDAQ 100, not the big NASDAQ, the YM, which is the Dow, the TF, which is the Russell. So if you look at the major markets on a daily chart, they're all doing very well. They had a little hiccup on Thursday, traded up on Friday. If I look at what looks the strongest, NASDAQ does. NASDAQ continues to move higher. I get the sense that the E-minis, the YMs, are stalling, and the TF is also stalling. That said, pausing to refresh is not a bad thing, and this market has seen a lot of up and down, you know, mostly up, but it changes which group is moving from time to time. The VIX, why did I play the SVXY short? Because the VIX gave a spike, but by the time, you know, I think I took the trade around 2 o'clock on, I think it was Wednesday, and I sold it at 10:30 in the morning on Thursday. It was not a trade that I wanted to be in for long, and I was able to take some quick money out. Just look at how expensive SVXY is, and if you went short from about, it was like 132 and covered at 125 and had a big position, it was a nice trade, but you had to be watching the market or else you would be probably break even today If you did options, maybe with premiums, might even be a little bit in the hole. And the dollar failed at the 50, which is good if you're a U.S. equity person, especially with a big multinational presence. But it might be bad if, on the other hand, you're a strong dollar fan. On the weeklies, here's where the runaway train comes in. There's no pausing. And this is why weeklies are important. Yeah, we slowed down at the end of the week. But if you look at the E-minis on the weekly, the NQs, the YMs, the TFs, even the TF, the Russell Futures, which may be the one with the biggest recent pullback, have closed at new weekly highs. So we've got these white bubbles are the highest high in the swing, and this is the lowest low, and it usually looks at the entire length of the chart. But this is the highest high of all time on these 4 weekly indexes. You can see the VIX is at the low on the chart, and the dollar has come off its highs on the weekly. So, you know, that brings to mind the Soul Asylum song of Runaway Train, and why you've got to be very careful to be shorting this market. Now, we may open up down 500 points tomorrow. Who knows? I have no idea. The futures aren't out and the world hasn't blown up, so I doubt it. And there will come a time when shorting the market is king. But I learned a long time ago, as I mentioned before, I don't short because the market has gone up too much. I short when the market starts to roll over. And right now, you know, if you want to do a couple small short positions, and I have one that I'm going to probably put on Monday, you do it with the knowledge that you're testing. And what I find is if I put out a order at the bid, not the ask, and I get filled right away, or it seems like an easy fill, then I'm probably wrong and people are taking my money. But we shall see. Here's the view where I look at just daily, weekly, and monthly, and I have starts with the E-minis, then the NASDAQ, then the Russell, then the NYSE, and the Dow. And again, not to beat a dead horse, but we are in a beautiful uptrend in all sectors, all time frames, and even the laggard Russell finally, and this isn't all the way over, so ignore that last spot there. That's what the red arrow means. Even the Russell has weekly buy and is at new highs. Let's look a little bit to get a sense of, in this market, where are we falling? And you know, what I really do with this is I look to get an idea of you know, breadth, impact of interest rates, and things that may want to affect my portfolio. So first thing is, you notice in yellow is the S&P, and white would be whatever is described on the slide. The left is the 10-year yield, the right is the 30. You notice the market did pull back as yields started going up, or prior to the yields going up, prior to the Fed meeting, and it's been going in sync with yields. I think there's a sweet spot in yields. I've sort of put what I think is the area of the sweet spot. As long as I don't go above the top of the bar, which I think is a little bit less than 3%, then the market's probably going to behave. Down here on the bottom, it might seem great to have super, super, super low interest rates, but you have to ask yourself, why? If I have super low interest rates because the world is imploding, that can't be good for my stock. So we are bouncing around the bottom of this range, and that's kind of supporting, I think, a strong market on both the short and the long-term interest rates. And again, when you're in the penalty box on rates, that's good for dividend payers like REITs, MLPs, utilities, home builders, people that are taking loans like utilities and home builders. And when the rates get sky high, that's good for banks, especially regionals and insurers. In the middle, it's mixed, and we're in the middle. AD lines on the left in white would be the 2,000, the right would be the 1,000, so the small mid caps on the left, the large caps on the right, and new highs on AD lines. No evidence of divergence there, and you know, I would expect the indexes to continue going higher and the number of new highs to be dropping off prior to us rolling over, but there's no guarantee. Again, the white represents what we're looking at, the yellow, is the S&P 500 as a comparator, and you could see that stocks above the 200-day are in the upper part of the range, but not above to the point where you have to reverse. And the stocks above the 40-day are also in the upper part of the range, but not near extended. So what I see is strong markets, not necessarily screaming overbought conditions. 3-month new high, new low. Whenever this hits this line, the market seems to pause. We've turned back down, so certainly, again, not a strong market, but by no means screaming overbought. A little bit of flame or pain, perhaps, or where everybody might not be participating. This is the daily McClellan. I just want to point out two things. I want to point out that the market's seeing newer highs. The oscillator is positive but turned down, and the summation index is negative. So that suggests to me that in some essence there's a divergence there where we've had lower highs on both of these while we've had higher highs on the market. And perhaps that's indicative of, even though it's a strong market, not every stock is participating. And this is the daily or the weekly. And again, pretty much the same pattern. We haven't been able to break the midline of the summation index, although we are positive on the oscillator. So the McClellan, to me, and there's probably better ways of interpreting it, but the way I interpret it is there is some divergence here, and that is potentially bothersome. But, I'm going to wait for the market to tell me it's turning over, not tell it what to do. Other breadth things that I look at, the buckets. This is an automated scan in EdgeRater. It's one of the first things I do every night. At my live meetings, I plot these scores in market tops and lows, and there's no question when I get 20% or more of the stocks trading below their Bollinger Band, 30 to 40 above their Bollinger Band, that the markets return to the mean, and they reverse. What this test does is it takes the stocks in the S&P 1500, and that was stocks from I built it in January 1st. I'll update what's in there. And March 1st is usually 1 or 2 changes. Doesn't affect this, though. And then first thing I ask is, if I look at the individual charts of every stock in the S&P 1500, what percentage of them are above the midline of their Bollinger Bands, and what percent is below the midline? And that's what this pie is. And we've stayed the same over the week of 70%. That's bullish, but not overdone. And then I look at between, which decile, 0 to 10% of percent B, 10 to 20, 20 to 30. And percent B is what percentage between the top and the bottom of the Bollinger Bands did you close at? And I look specifically at how many are below, which would be less than 0, or above, greater than 1, to get a sense of where these stocks are. And the interesting thing is, despite going higher this week, we actually backed off the number of stocks above in the top part of the Bollinger Band. So again, strong, not extended to the point where it has to reverse. HINDY is an indicator that I plot on charts. I run this scan, again, automated in EdgeRater, looking for a Hindenburg omen. I've talked about them in the past. We don't see one, haven't seen one in quite some time. A Hindenburg omen is a signal that you'll see a series of prior to a market correction. It's been right for the last 50 years. The absence of one makes me feel good about the market. A single one is interesting but meaningless to me. When I start to see several of them within a week or two's period of time, that tells me that the market's highly likely to have a major correction. So I look for Hindenburgs. We don't see any. Market tone, remember, it's this third set, which is the Ian's Woody indicator. Green is good, red is bad, yellow is neutral, and you could see we're in a all green, all long mode. Now, interestingly, the market's moved quite a bit in the yellow mode. And if you look at the typical duration, 10, 12, 13 days of green, we're in the beginning of this move up. We'll see if we can get it. Now, I'll mention kahunas, and kahunas are more than a 0.24% move within the change in Bollinger Bands over, or percent B in a single day. That would be the light kahuna, which is the pink. The deeper red would be more than 0.4. To the upside, it's light and dark blue. Typically, what gets me into a strong market or into a weak market is when everybody throws a kahuna in the same direction, opposite of where the market is. So we'll be looking for kahunas, but right now market tone improves. And in fact, if you look at sectors, the only sector that's sitting red now is energy. And if we go back a week or two, we were mostly yellow with a couple of reds. So again, my sense here is that the generals, in many cases, in certain sectors, are driving the market hard and higher. But the fact that some of my breadth indicators are not at extremes, despite being at new highs, that is a divergence, and that does suggest to me that not every stock is participating. I look at the Canaries. These are a group of stock leaders that we've picked in the past: the Baidus, the Apples, the Netflix, the Amazons, the Pricelines, the Googles. What we do is we create an artificial index, and we look for evidence of that index rolling over. You could see, we had a weak January. We actually had a weak December in 2015, for example, where my arrow is. These turned over before the market did, and they actually turned around in preceding the market. So I look at these as a signal of the big generals, if they're changing, that may pull the market with them. And right now, strong week in the market, they went sideways, but that was pretty much digesting a pretty big move here. Know your news and earnings on the left comes from Bloomberg. I probably should. Okay, somebody from Bloomberg gets pissed that they don't see their reference. There you go. So we know the market is closed for President's Day on Monday. I've got a lot of Fred speak. I think we're going to hear more and more tones that we have a rate hike coming sooner than later. Hasn't seemed to spook the market. You see some inflation numbers, rig count, be some employment numbers somewhere here, jobless on Thursday. And then earnings seem to be slowing down this week, but you can see there's some biggies. And I take this out of briefing.com. Tesla, Home Depot, First Solar. First Solar, it looks very buyable if you believe in bottom fishing stocks that have some momentum coming in. Problem is, I get nervous buying it before earnings. I think I'll wait for earnings to come out and reevaluate. JCPenney on Friday, some energy with Apache on Thursday. Market thoughts, they certainly continue to extend to new highs. Is this a Trump rally? I don't know, but clearly if we spend for infrastructure, hence material stocks, cement, steel, or if we reduce regulation, think banks, the stocks will continue to rally, and that's probably directly related to Trump. The thing that I think is probably more important, one that was being talked more about on CNBC last week, was earnings growth coming back into the market and how earnings have been flat for the last couple of years. As I said, Fed speak to probably increase the expectations of March rate hike, but so far the market's yawned. As I've said a couple times, I don't think every stock's participating. When I see a VIX this low, as long as it stays this low, I'm going to make money on the long side. But at some point, the VIX is going to come up, and the more complacent we get as a market, the more likely we'll get a shock. Semis still look strong. Banks paused, trying to figure out the regulatory front. And energy weakened this past week despite strong seasonality. Again, we're due for a pause or correction, but be very careful shorting a runaway bull. The market will give you plenty of time to get short when it's ready. Now, I will say it's not a bad time to be booking profits. And I have a lot of profits still on the table. I've booked some this past week. And I'll probably book some more. I do a lot of option trades, and one of the things that I learned from John Person, let's say I was in a $600 call for Amazon. In the old days, I would just keep rolling it over because it only cost me $1 or $2, and I wouldn't tie up any of my margin dollars. It would cost me the intrinsic value between the 600 and the price of the stock. If the stock's 840, it would cost me 240 plus maybe $1 to roll that option instead of 840 for the stock. And then what I would do is write a sell a call against that call at maybe 900 to pay for that call and put a little bit of money interest in my pocket. I've stopped doing that I like doing deep in the money calls because the extrinsic portion, the premium that you pay is small. But then the stock does a nosedive and I get the same loss as owning the stock and none of the benefit. So I've been rolling up and rolling out. And what that means is if I had a 600 call, I may have sold it, bought an 800 call. I may have to pay $5 or $6 extra in premium, but I put the $200 in my bank per share. And if the market corrects down to 700, I'm in much better shape. So I've been rolling up, meaning buying higher strike prices, and rolling out to later months on a lot of my option positions, which, again, banking profits, and it's its own protection because now I've got a lot less to risk if the market corrects. Usual agenda from top-down review. And again, pause this if you're interested and write down those email addresses. I will not hold my meeting unless two things happen. Greg commits to his meeting. I think he's pretty much committed to it. I bought my return ticket, which was expensive, from Santa Ana to New York, to be at New York on Monday night for work. So I hope he has it. And, you know, assuming he has it, and if I get at least 5 people interested, because I don't do my summits. I'm not a pro. I don't do it to make money. I do it not to lose money. I need at least 5 or 6 people there to defer the cost and keep it a reasonable price. And I only charge for what it costs me for the room and whatever else I have to do when I'm there. So that's my email address if you're interested. And then John Person has a special on his meeting. I think it's like $600 or $700 off if you register soon. All right, time to go look at the charts. I usually very quickly jump into TradeStation and I go into my market force and divergence. So I'm looking at 5 elements here. And those elements are, we'll take the E-mini as an example. I always forget to make this daily. Just save that. So let's look at the E-minis. All right. Come on. All right, here we go. All right. Make sure we're good on that. All right, so I look number 1, what is the primary trend direction and when was the signal? That's the Person PPS indicator. Green is a new uptrend or a buy signal, red is a downtrend or a red signal. So I'm in a buy daily, weekly, and monthly. The second thing I look for is the color of the paint bar. That's usually something called the Alexander Elder Impulse Indicator. Note the color down here usually reflects the weekly bar. This color reflects the daily bar. Okay. Blue is neutral. When the bar is blue, it's okay to go long, short, or hold. When the bar is green, I should only be going long or holding. When it's red, I should only be going short or holding. So green is better than blue. Now we've gone to blue on the daily, so that means perhaps a little bit of exhaustion is coming in, a little bit less participation. Still on the weekly and monthly, we're green. Third thing I look at are for these little red dots. The red dots on top of the stock suggest that we have some MACD divergence. So, and again, less support of the rally. Over here, we have red dots also on the weekly, so that's a negative. Fourth thing I look at is where am I falling within the envelope? This is the Elder envelope. And I know from experience that whenever I get outside that envelope, I come back in. I will also tell you that as long as I'm on the inside of the envelope, I can ride up the upper boundary of the envelope for quite some time. So on these 4 indicators, it's mostly bullish, a little bit mixed. The fifth thing I look at, and the reason why I think the E-minis need to rest here, and why I did take a short position on Friday on a 3x S&P 500 ETF as a small, cheap insurance policy on my positions, is the fact that the high jump's up to 94%. The high jump is a mathematical determination of taking 3 numbers: the price to the 17-day, the price to the 50, the price to the 200. These are all simple averages. I add them together, I plot them, And when I say 94.83%, that means if I look back a year, this is as not within 5% of the most I've been extended. And when a stock gets extended or a market gets extended, it comes back. So a little concern there on the E-minis. On the Dow futures, 86 or less extended there. Looks just like the E-minis without being at the high jump. Also has the red dots on the daily and the weekly. If I look at the NQs, now last week the NQs were high on the high jump. They're at 99%. That means in the last year this is as extended as they've gotten. Notice how they are running up the upper bound. They're actually outside the upper boundary. I clearly expect these to come back. Because of that, at the end of the day, I did some SQQQs. And I'll show you an example of what I'm willing to do to ensure my portfolio. I lose most of those trades because the market keeps going up. That makes me very happy. I typically close them out on Monday morning, but it's sort of the what happens if the market gets a shock thing. And when I see 99% on the high jump, I'm outside the envelope. We could still go higher. Maybe we're in the midst of a blow off that we won't recognize until we get finished. But that's a little worrisome, although it's worrisome only because the market is so freaking bullish looking. And then lastly, the Russell, which I said, turned up this week, also in a buy signal, but blue on the daily and the weekly, only at 63%. So the lowest risk I see is on the Russell. So thoughts here, very bullish market, high risk. Looks like this one needs to take a pause. I don't know when that's going to happen. Okay. Now, there's probably some of you thinking, well, I'm just going to buy, and I'm not saying this to pick on anybody because I've been there and done that. Why don't we just buy VIX? Jeff, you keep telling me the VIX is low. I'm just going to buy the VIX because the VIX has to eventually go up eventually. I just want to show you why you have to be careful on some of these ETFs that I might talk about, and I've already mentioned a couple. And let's just look at the VXX. This is a instrument that doesn't look too bad. That's a daily chart. Well, let's look at here's a daily chart on the VIX, and you notice that in less than a year, the VXX has dropped from close to 100 here, 76, all the way down to 17. Well, it's really low. It's going to go up from here. Let's look at a monthly. What this puppy does is it will fall. As long as you're in a bull market or in a bullish trending market, the way that these instruments are designed is they will keep getting lower and lower and lower and lower. And how do you make money on this chart pattern? Well, it's simple. The only way you make money on VXX is if you trade VIX with intraday on small time frames and you don't stay in the stock very long. Now, the way I played volatility last week, I went with a different ETF. I went with SVXY. And why did I go with SVXY? I went with SVXY. Let's get into a daily. I looked at the move that SVXY has had, and it's doubled since the election. It's probably the strongest, as strong a looking stock as I've seen. And my bet was, make this candlesticks, that we were going to have a reversal. In fact, if I put on a weekly, this bar here only closed in the middle because of Friday. It was a shooting star when I went into it on Wednesday and Thursday, and I closed it Thursday when the stock started moving back up. I think this one's that's a reversal pattern. I think that this thing goes up and it comes down hard, it goes up and it comes down hard. It's gone up really far, And so I took a short in that, and I made some money on the short, but I was out of it, within a day. So be very careful with some of these ETFs. They can move fast and hard and long, but they don't move forever. When they move the other way, they come down very fast. The dollar, hope that made sense. That was a warning, I guess. Dollar remains in a daily sell, but in a weekly and a monthly buy. Blue is in neutral, 60% here. The dollar is neutral at a point where you might expect it to bounce, as it's doing here on the weekly. Oil, seasonally strong period of time, but you look at oil, although daily in a buy, weekly is in a sell, monthly is in a buy. It's doing nothing. It's going sideways. You look at gold. With the weak dollar, you've had a big move. You can see it better on the weekly. You're still in a buy. On daily and weekly, long term, you're still in a sell. You're at 53%. You're a blue bar. We'll look at gold and make comments later. Silver has always looked a little bit, recently has looked a little bit better than gold. We'll look at that later as well. So my initial impression is, as I said over and over again, market is super strong. When I start to see major indexes at 99%, 96% of their high jump, I know that that doesn't last forever, and there is risk that this market will reverse. I don't know when. It may go up 10% from here, so I'm not telling you to get in front of that in shorting. And I'm not either, except I bought protection over the weekend. Very quickly, healthcare, XLV, 90% on the high jump, green, blue here, in buys everywhere. Healthcare looks strong. Watch some biotechs this week. Finance got up pretty high. That one doesn't have much data, so let's go to FAS. Finance still within the envelopes in long-term and short-term buys. Blue with some MACD divergence, 84%. Finance seems to be stalling until we see interest rates move or regulations improve, which they will. Discretionary in a buy signal. I was telling you, this is a very strong market. Technology, boy, does this thing need to correct. Why? It's outside its envelope now for 4 or 5 days in a row, 6 days in a row. It's got the MACD divergence concern. It's at 100% of the high jump. It's a blow-off top on technology. How far will it go? It ain't over till it's over. XLI rather, industrials. Also in a buy in all 3 time frames, 84% on the high jump, seems to be pausing. Staples, also driving outside its Bollinger Band in a multi-buy. I mean, this is a multi-sector strong market. Materials weakened a little bit during the week. You can see both the daily and the weekly have gone to blue. You got the red bar dots above the weekly, but still in a buy signal. If the market's doing this well, you expect utilities to be weak, and utilities really, they're not that weak. They're just sideways in a buy signal in 3 time frames in green. Energy, well, there's your weakness. Now, interesting, you had a doji on Friday. Will that be a reversal sign? We'll see. But you've got red bars. You've got sell signals in daily and weekly. Even on the monthly, a nice little flag here. Could be a bull flag and go right back higher. Energy is the weak part of the market, and we already looked at finance. All right, strong market. Next thing I'm going to look at is an HGSI. Let's go and take a look at where the strength and weaknesses of the market is. And this, what I'm doing here, everything I've done so far except talk so much and explain different positions, I do this every night. I then go into Woodward and Brown Groups Full, Major Markets Plus. I use what's called a top-down view because that one's all price and volume. I make sure I'm ranked by raw combo, and it shows me the strength of the market. NASDAQ Biotech, no surprise, it's at 100% on the high jump. Weakness, gold miners, silver, small stocks, interestingly, commodities, dollars in the middle, VIX is near the bottom. All right, take a look at some things. Let's start with the I want the S&P 500, not the iShares, so let's get to the S&P 500. So I'm going to very briefly tell you what you're looking at here. On the top is it's a proprietary, in fact, I was involved in developing it, buy-sell indicator. It's called the Bongo. We share what's inside, and we include it in the program at no cost. the top is the weekly, the bottom is daily. I like to be long when the weekly is green and we're coming out of a short-term pullback and the daily is red. When they're both green, we're in long mode, and we are clearly in long mode. I then paint the Hindenburg using a couple different measurements here, and as you can see, we had one in July, one in November, one in December, and what we're looking for, and again, I apologize to people that are here every week, we're looking for the Hindenburgs to look like this, where you start to get a series of them, and that, frankly, this called a big correction there, and I would say that called a big correction there as well. When I start to see that pattern, I pay attention. Down in the price window, obviously candlesticks. We have an exponential 8-day exponential moving average, either Ricky Sadler or Steve Bigelow, whoever wants to take credit for that. That's magenta. The rest are simple, 17 in green, 50 in blue, and 200 in red. Down here are my kahunas. The kahuna is a move with percentage move within the Bollinger Bands. The deeper the color, the bigger the move. Blue is good, green is good, red is bad. Down here, and it will shift in the next few, I apologize. Those are Eurekas in green, Phoenix in red, and these are the follow-through days in HGSI, similar to the follow-through days in IBDinvestors.com. Now look how good these follow-through days are. I pull back to the 200, and then 2 days later, or a day later, I moved above it and had a follow-through day here, and then a couple days thereafter, my bongo turned green as I went above the 50, and I got an all-clear signal. The market pulled down here, and then the next day, I got a bongo, and then a couple days later, I had a Eureka, and then a couple days later, my bongo turned green, and I was off to the races. So I look for that on the market. At market tops, what do I see? I see the reds come in, the phoenixes, and the kahunas to the downside, and the red on the bongo. Here's the S&P. I can't say anything except to say what a beautiful market. Let's just step out and look at weekly on these things. Breaking out to new highs, everything looks strong. If I look at the Dow Jones Industrial on the weekly, I can't say anything else. New highs look strong. Is this the blow-off top we've been looking for? 180 points since the election, maybe. Excuse me, not 180 points. Let me do my math. 1,800 points. Is it, let's take a look at the NASDAQ. Breaking out to new high, was in sort of a wedge, broke out of the wedge here on the weekly. And lastly, and I'm looking at weekly charts because they all look so strong, I don't want to bother with the dailies. Russell. Hard to say anything but great things about this market. And again, the last couple days, the Russell looks like it's gone sideways, but we're at a new weekly high. If I drop down and look at the dollar here, the dollar broke below the 50, failed to get above the 50 here on the daily. So it's in a bit of a trading range. With the dollar coming off its highs, that means gold has had a little run. Whether I look at gold, which paused this week, but a nice move off the bottom, or gold miners, which look even better, got up to the 200 and paused. Notice the bongo buy signal on the weekly is green on the miners and green on gold. So gold looks like it may go higher, especially if the dollar languishes. Silver, as I said, I think looks better than gold. It's actually closed above its 200-day moving average. So I look at this. Let's close with volatility on this group. Again, everything I'm showing you is built in and found within HGSI. We're not down to the lowest low, and we failed, as we have many a time, at the 50-day moving average until we close above that 50-day moving average in blue and then above that 200-day moving average. It's hard for me to believe that there's much volatility in this market. So what does this tell me? It tells me being short, probably still dangerous because there's no clear-cut sell signals. One day we're going to hit a new high, and that's going to be the day that's the last new high for a while, and it's time to go short. I don't know when that's going to be. This tells me there's low volatility, and I'm going to watch it. It tells me that premium on protective puts is cheap right now. Problem is, let's say Amazon's $8.40. Let's say I pay $10, $12 and buy an $8.30 put, And then Amazon goes to 900, and then it rolls over and trades down to 830. Well, yeah, I protected myself at 830, but I lost all the time between 900 and 830. And puts are cheap for a reason. Nobody wants to buy them because there's not enough volatility in the market. Next thing I look at is industry groups. So I go down to group 7 here, and I go and look at, I've got 172, 2-day force. I was at 85, I think, last week. We dropped to 51. So that's another sign that the moves may be narrowing the participation. We only had 2 groups to the downside last week, and if I remember correctly, we got a bunch this week. So to the downside, metals, banks, as I said, they're not doing much right now. Life insurance, PC insurance. So those all would say that they don't think rates going higher. And there's not inflation, perhaps. And then you've got home builders that should be up with rates being lower, and they're on this list as well. Note for 5-day performance, all of these, except for precious metals, were up, including diversified banks were up 3.69%. The 2-day force looks at price and volume for the last 2 days. The direction of the force is very much determined by the price. The bigger the volume, the more likely you go to the top of the list. So banks are always at the top, whichever direction they're in. It's a quickie indicator, but when I see you've been strong for 5 days, I'm not going to put a lot of value in it. For a 5-day window, it's a little bit longer time frame, and you can see things that have been struggling over a longer period of time, 28 groups, and working over a longer period of time, the 5-day up, we've got 58. So let's go up to the short-term movers, and this is, make sure I have raw combo rank. These are the leaders. I said in my intro, semis were strong. If they're strong, they may be getting topping, and we'll go through a first bunch. Skyworks, this is a typical pattern we saw. It's a beautiful pattern. Now let me confuse you and drop down to a different view. Let me tell you what I did, what I just added. Don't freak. Up here, our earnings per share growth. I want to point that out. We have revenue growth here. These are the next 2 quarters of earnings per share growth. These are the last 4 compared to the prior quarter and the same quarter. So December compared to December. Okay. This is a graphic depiction of revenue in red and earnings in blue. I can cycle up here and hear what the company does. I know they're a RFID manufacturer, but what the RFI manufacturer, but what they really are is a big supplier to Apple and the iPhones. Down here, I've got my bongos. The 3rd green bar I added is called accumulation distribution. For everything, green or blue is good, red is bad. Accumulating means people are buying them. Distributing means they're selling them, people being the institutions. Not going to spend much time talking about the 2 and 13-day force, but this is a momentum indicator, and just like the bongo, I like to buy stocks where the long-term force is up and the short-term force goes negative and turns positive, showing me that there is a change in momentum, price and volume. The next bar is the high jump, and you can see the high jump bar here. Let's open up my little legend. You can see that the high jump bar here, they give you a number. That number means nothing to me. I've converted that to a percentage on my tools, but I can see graphically it's near the high that it's been. The red lines are called red candle highs. Those are potential reversal signals. The green ones here are green candle lows. The next bar, which there's not a lot on it, are buyable gap ups. This is from Morales and Catcher. Then the squeeze is in yellow. The green are mobile breakouts. Down here, this is the industry group strength. It shows you how strong the industry is. We have the price bars, the same moving averages. You notice the green dots below, the red dots above. That's Wells Wilder's PSAR. PSAR reversal is a signal to me for potentially buying. Down here, I've got Morales and Catcher pocket pivots. I've used OBV with a moving average instead of regular volume bars. And on the bottom, I have regular volume bars with my kahunas. On the OBV, I left my Eurekas and Phoenixes. Note that the Eureka and the Phoenix are calculated on the major index, not on a group or a stock, so they never change. So, Skyworks. Sideways for a month. Earnings are out. Big move on Friday, I think tied to some good Apple stuff. I had a kahuna, a pocket pivot, a PSAR reversal, and a prior day at a mobile breakout from a squeeze. Everything is green. You know, do I chase stocks like this? Probably not. But, I mean, let's do the math. I moved from 78 up to the top of the flagpole, was at about 94, so that was a 16 point. I went sideways, and I broke out of the pennant on Friday. I guess my target's 109, 110. So if you wanted to chase, this one looks like it's going higher. I'm bothered by where it sits on the high jump. I'm bothered by where the market is. But what a beautiful looking chart. If I want to know why it moved, I can go to FinViz, more info from the web. It's going to pull up Skyworks for me. And it's going to tell me what happened on Friday. iPhone 8 speculation. Speculation that them and Broadcom are going to be two of the component manufacturers. Broadcom, I am in Broadcom. Now, when do I want to buy these stocks? I want to buy the stocks here. I want to buy the stocks here. I want to buy the stocks somewhere in between this period of time. Perhaps I'm going to buy it there. And I think that would be a perfect buy point for how I trade. And I'll have to go back and see if that's when I bought it. Why is that a perfect point? I had a mobile breakout from the squeeze. My bongo green weekly is green. I am coming off of the 17 and the 8. I'm not extended. I'm in the bottom part of my high jump bar. I had a pocket pivot that day, a kahuna, and this is a doji here, a high close doji. So this was a great day to buy it. In fact, I should have bought it that day, and maybe I did intraday when it took out the PSAR and the intraday charts. Broadcom looks great, like Skyworks. I don't know if I'm chasing at this point in time, if I would go back and buy it new. Micron, bit of a better buy time. Now, let's look at this and let's talk about what I just said. Pull back to major support, not quite there, but maybe close enough. But I don't buy it until I see some blue or green come in and give me some momentum. It's still in pullback mode. Here it was in pullback mode for 20, 30 bars. And then what happened? Sitting on the 50, a kahuna mobile breakout from a squeeze, bongo green went green, weekly bongo was green, and the daily turned green. That was a buy point. Here was another buy point, but off the 17. This move off of the 50 is one of my favorite places to snipe and buy these things. Now, mind you, it's not the pullback to the 50 that I take. It's the pullback to the 50, a base, and a breakout. High likelihood of success versus without the base. Analog devices has been in a big run, good earnings per share growth. Intel laggard. I just wanted to show you. I've been talking about how I've been Aquilero, and I kept telling you why I shouldn't have been in, but I stayed in it for a reason. I stayed in it mostly because I'm a sucker for earnings per share growth, and I saw the massive earnings coming in, well, percentage growth earnings coming in. And it was a great Darvas box. When you break outside the box or above the box, there's a buy signal. This gave us a buy signal this week, and it had a nice move from that point. And that's another breakout. So you notice breakouts are working in semis. It's been a while. Several others broke out on the list. Biotech. You know, biotech right now is a story of takeovers, small biotechs. But what I see with Celgene looks really interesting. This is Clovis. This is a potential takeover candidate. They got a recently approved drug for ovarian cancer. As a cancer doc, I will tell you that Tesaro's drug beats theirs, but Clovis, Tesaro, and AstraZeneca have a similar class of drugs. What popped the stocks this week are both takeover speculation, Sanofi for Tesaro. Gilead's got to buy one too, and or Insight. But the other thing that happened is AstraZeneca showed some positive data for this class of drug that the three companies have in breast cancer. So Clovis, pull back, high base on the 17, pocket pivot kahuna, it's running again, mobile breakout from a squeeze. Again, it's not running because of earnings per share growth and revenue, it's running because of takeover speculation. Celgene, ugly. I mean, it's sideways, it's loose, but all of a sudden, my weekly bongo went green. My group is through the roof. I'm breaking out of, a sloppy pattern, double bottom, short-term bottom, I don't know if you can call that. Pocket pivots. Let's look at this on a weekly. Kind of looks a little bit better here. Cup, handle, potential breakout. I'm not saying it's breaking out. I'm not a perma bull on Celgene like I was back when it was doing this. This is when you're a perma bull. Okay, now I'm a cautious bull. I think Celgene's going to run again. Celgene runs, it pulls biotech with it. Obviously, Washington controls everything from a perspective of legislation and regulatory and pricing. Don't know anything about Sage Therapeutics except it's breaking out to a new high. Again, notice the revenue line. A lot of speculation in this stock. Here's Tesaro. Tesaro, and I can't trade this stock because I do business with them. Not that I'm necessarily an insider, but that's sort of my deal at work. And so I don't trade the stock, but it's gone up 4 times since ASCO last year when they had good data in June. Speculation that's public is that Sanofi's looking to acquire them. They have the same class of drug as AstraZeneca. They've had a big move. Amgen, another bellwether biotech. So when I start to see Celgene and Amgen, you look at a weekly, it's been doing nothing going back for 3 years, 2.5 years. Is it going to break out here? I don't know. But I'm seeing a lot of movement in biotech. So one way to play this is LABU. And, LABU, this chart doesn't look like much. But let's say that you trade my style. Here's your mobile breakup from a squeeze, a break above the 50, a pocket pivot and kahuna. And the way I trade, I would have set a buy stop to be at the closing high or just above it. I would have set my sell stop to probably be sitting right below the convergence of moving averages. That didn't work right. I took my finger off the bar, the wrong bar. And had I taken that trade in just a short period of time, it doesn't look like much, does it? I took the trade. It's up 21% in 12 days, 12 trading days. I think LABU has potentially a long way to run. Again, it's fraught with risk that the government's going to do something about pricing. The benefit of the ETF is if one drug company in the sector gets bought, you still get the benefit. You might not be in the right company. If there's failures or successes, it doesn't sink you like it would an individual stock. All right. So biotech looks interesting. I know I'm talking a lot today, so I'm probably not going to go through all 10. Household products, how boring was it? Takeover talk, Unilever being acquired by, I can't remember who was looking at buying them, like a $130 billion transaction. Hold on a second. Did I just screw up? Yep. All right. Let me go back here. All right. All right, so here's Unilever. You can see, I don't know how to play. I don't usually play those unless I know some. Colgate Palmolive broke out on this news. Mobile breakout. Excuse me, a Bible gap up. Pocket pivot kahuna traded above the 200. Pays a 2.2% dividend. No better way to wake up a dormant group than with a big takeout. Kimberly-Clark breaking out. Procter & Gamble. I like this one the best, although you might say it's extended. The high jumps up too high. I hate buying things in the lower right-hand corner. Estee Lauder, got to get above the 200. Clorox had broken above a few days ago. Big volume coming in. So this group, which to me is a boring group, does pay a dividend, moving probably because of Unilever. Entertainment content, I think there's one stock that's driving that, and that's CBS. I don't usually buy things that are performing less than the index. Now, CBS is sort of going sideways. It's basing. It's sitting on the 50, had a pocket pivot, had some kahunas. Looks like it wants to go higher. Don't like the earnings per share growth. Must be a story here. More info from Web. Left click on FinViz. It'll bring up CBS. Well, it's interesting. Bad news comes in to the company and they trade up. All right. Not usually my reason for it. It must be less bad news than the street expected. All right. Next group down is communications. I do want to look here because one of my favorite stocks to buy now is here. So one of them was Arista. And Arista has been given a buy signal for weeks. Notice the pattern. Uptrend. Pull back to the 50, and what do we have right there? Tough to buy, right? I agree, because the bongo was red. But it broke out on Friday. It marched up the 50. It had a PSA reversal over here. Again, tough to buy because of the weekly bongo being red, had a big breakout. But there are other stocks here that look interesting. Cisco. Remember this boring old stock? Kahuna, pocket pivot, mobile breakout, everything is green. Back here, pre-earnings. Again, you don't have to necessarily buy before earnings. Had nice earnings, stock gapped up, moved up higher. So Cisco still looks strong. Apple, all-time highs. I think is speculation about the iPhone 8, sometimes called the 10. Continues about all the great new features that not just an incremental update. You'll see the stock go higher. Here's the one that I've been nibbling on. In fact, I've been in it for about 5 days. This is Acacia Communication. Earnings per share are great. Ain't the problem. IPO, major move up to 125, then came back down to the 50s. It hasn't turned green yet on the bongo, so that means it's a riskier buy. But it did have a PSAR reversal. I actually took it down here. And I took it down here because I don't know if I thought this was a double bottom. It was a little bit early for that. It just felt like it was, as Dan Fitzpatrick often says, done going down. It's had a nice move up here. Now all of a sudden it's a lot easier thing to sell you. I got Kahuna as a break above the 50, strong group strength. Like to see that bongo turn green, but Acacia looks interesting. Sierra Wireless had a buyable gap up here, I think, on earnings. Looks strong. So this is a strong looking group. Again, how do you get 25% returns in the last 2 months? You buy the right groups. Telecom carriers, there's both M&A activity with talks about T-Mobile, and then you've got the whole issue about the new pricing that's come in. So I'm not going to spend much time about Morales and Catcher, but if you read his book, you would see why this was a strong buy signal, a kahuna on a Bible gap up, despite the bongo being red. And frankly, it never violated the bottom of the Bible gap up bar. And had you bought it somewhere on that day, you'd still be long and have made some money. It's giving us another buy signal here. Mobile breakup from a squeeze, pocket pivot and kahuna after pulling back to the 50 with a PSAR reversal. There's M&A activity there. These guys are trying to see who can go to the bottom first on pricing, but pays a 4.7% dividend yield. You're buying it on the lower part of its oscillations or cycling. Don't know much about DigiGlobe. No dividend, big move on Friday. Sprint, not as pronounced as T-Mobile, but notice it had a big move on Friday with volume coming in. So this is an interesting group, especially if you want to go after some dividends. Airlines, interestingly, make it to the list. Thank you, Warren Buffett, talking about his position in Southwest and some of the others. Ever since Warren talked about buying airlines, they've had a nice move. Southwest, this is when you want to buy. This is to get you interested, and then you're looking for the breakout here. Kahuna, pocket pivot, mobile breakout from a squeeze, Bible gap up. And the stock has moved higher from here. That's Southwest. I am in Delta. Delta's sort of been in sideways for a while. This is when owning options will kill you, because unless you're selling premium to pay for the price of the option that you're buying or rolling over, you're just spending premium dollars and getting no growth or loss on the stock. So going sideways, looking for a reason to go to buy more. JetBlue down. United Continental looks a lot like Delta, sideways, maybe breaking out here. So airlines look interesting. So I'm getting tired, so I'm not going to go through the rest of the groups, I think. Let me just see what I have here. That's applied material. Yeah. So basically what I do is I go through the top 10 groups. I do exactly what I did for you. I dump them into a buy list. I put that buy list into TradeStation or Thinkorswim, where I follow it. I supplement it daily with my scans and radar screen, and I buy and sell based upon my signals. So a couple of different things I like to show you. I get a lot of, Jeff, that looks great. Boy, you really know what you're doing, but I don't want to work that hard. How do I just find the best stocks in the market? The word for that is a 4-letter word. It's called scan. And use your tools that you might have to go into a large basket of stocks and find the ones that you want to concentrate on. So on the weekend, I go a little nuts. On the weekend, I build a database of attractive companies and stocks, and I look at 500 or 600 charts. I don't do that during the week. During the week, I run 4 or 5 scans. I look at those charts. I add them to my buy list. I put in some orders, and I move on. I want to spend 45 minutes at night during the week. I'm okay donating a lot of time on Saturday and Sunday, because if I'm going to do this webinar, I got to know what's going on, or think I know what's going on. So here's the difference. It is a weekend. I create every weekend a number of lists. Some of these lists come from MarketSmith. Some of them come from IBD. Some of them come from OmniTrader. I do this only on the weekend because it takes a lot of time. I take these lists, and I have bullish stocks and I have bearish stocks. I then go into HGSI and I create each week a list of some other scans I like that are done automated in HGSI, and I'll come back to these in a second. I then take all, and then a couple of other lists that I do, like HGS 100, the GIF All-Stars, and I put all the bullish stocks into the list of consolidated buys. Let me take that off. And I started with 860 stocks. Now, in my younger years, I might look at 860 stocks. I don't want to look at 860 stocks. Let's limit them for price and volume, and let's put them I'm looking for one thing specifically. All right, I don't have it in here. Let's just put it $7.50 and 250,000 shares. Now I'm down to 678. I actually do 8 and 500, so let me just make it 8 and 500. I'm going to duplicate that, and I'm going to edit it. That's close greater than 8. And I'm going to put 500,000 minimum shares. Not an ETF, okay, and we're going to call this JAS, JS, 8 and 500K. Because I don't really want to buy cheap stocks, especially at the tail end of a bull market. I might buy cheap stocks at the end of a bear market. Now I got 492 stocks. If I go back to my filter and I allow ETFs in, now I'm going to have about 500, I only got 597. All right, so 497. Those are the stocks that I looked at. Now I have a second list where I add the S&P 1500, and here I had about 1,000 stocks, and I did some scans on those. So on the weekend, I actually went through those 500 charts, and these were the ones that came to the top as the stocks that I was interested in looking at. Now, there's all different reasons. Let me show you a couple of examples. First thing is, let's think about what we just did on top-down analysis. What were some of the groups we looked at? And I'm going to count up the groups that are here. Biotech, 1. Communications equipment, that's the second one. Semiconductors, that's the third one. So to start with, a lot of the stocks that I liked came from the same groups that were in the top-down review. Okay. Here's an ETF that I liked, which is the LABU. So a lot of what I liked showed up on that top-down review. Now, I actually subcategorized this based upon what the stocks were. So remember I showed you those Bible gap ups that worked? Let's take a look at Progenis Pharmaceuticals. Here is a stock that was going sideways, gave a buy signal right here. The buy signal came in here from the kahuna, the mobile breakout from the squeeze, but you didn't reverse the PSER, which is when I bought it, over here the next day. Forget all that. It's gone. History. I had a Bible gap up on Thursday. We closed a little bit above the top of the Bible gap up on Friday. The volume is massive. Something is going on with Progenics. I'm long Progenics, and it made my buy watch list. So that's a Bible gap up. Then I have bottom fishing. So I'm going to show you Impacts Labs. And I got a call out. John Person mentioned to me on Thursday, and I wasn't that impressed. I was wrong. This is bottom fishing. Kind of remember that acacia slide? Is this thing, how much lower is it going to get? It doesn't seem to drop much below where we're at right now. So that's a low risk buy. I had a couple of pocket pivots. Group strength is strong. And the weekly ongo went green. So on a bottom fish, what I do is I either pinch my nose and I buy it where it's at. But what I'm really going to do is look for a kahuna, pocket pivots, a mobile breakout from a squeeze. This is a watch list. Go back one more. How about broken out and running? Notice this is a large group of stocks. So several of these we looked at already. Let's look at U.S. Steel. Talked about this one a lot. Pull back here, and you got your buy signal. You got your kahuna, your pocket pivot, break above the 50, mobile breakout, and your green here. Now, if you're a bongo buyer, you've been long since here. Look at the volume that came in at that point in time. Bottom line is, this is a stock that's broken out. It's had a big run. Now I'm looking for another time to buy more. I have a pretty big position. Now let's talk about the devil in the room. Techminco, this has been a stock I've been very bullish on. I talked about it last week. You know, you got to watch earnings. Earnings came out on Wednesday, I think. It moved up on Tuesday and then, or Monday, whatever the earnings came out. The day before it moved up, and it's come down hard on earnings. I have a big position in Techminco. Notice the earnings per share growth. I had a put coverage. I had sold calls up here. I bought a put at the money. I sold a put down here to pay, so that my cost on the put was nominal. My put's at 23. I've lost a little bit of money, but not enough that's going to hurt me. And you know what? On Friday, I covered my put that money in the bank, and I bought more shares when the stock reversed. I still think Techminco goes higher, and it's, again, one of my favorite holdings. All right, that's a broken out and running. How about Leaders Extended or Gone? These are tough ones for me to buy. You know, the Exelixis goes in the category of I don't trade stocks and companies that I do business with because I don't want anybody to come by and say I was an insider, although I'm not an insider. But look at this. Here's the most recent time to have gotten in. Bongo up here was red. That's a problem. Back here. But what a great move up. Lower left, upper right. I think it potentially goes higher because of all the M&A discussion. This is a cheap biotech, Again, Gilead's got to buy somebody. They're only 6.6 billion market cap. They got marketed products. AAOI, Broadcom, these are all great stocks, great moves. This Infi is a semiconductor, not really extended, but certainly on a great move. So I have these. Pullbacks ready to run. These are some of the favorite places where I find stocks to buy. So these are the ones that made my pullbacks ready to run. Let's look at Rockwell Collins. To be in this category, you had to be in an uptrend. You had to pull back. And I love to find stocks sitting here on their 50 and put them on my watch list and take them when they break out. You have kahunas, pocket pivots, a break above the 50. If I just look at this whole group, Borg Warner, mobile breakout, pocket pivots, kahunas, PSAR reversal. And now it's breaking out. We already looked at Celgene. We already looked at Acacia. Notice Acacia, I didn't talk about the obvious here. It's still got a bongo red, but you had your bunch of kahunas. You broke above the 50 and had a PSAR reversal. Those may be running already. What about ones that aren't running yet? Let's look at NVIDIA. What do you mean it's not running, Jeff? Well, it was running. Sitting here on the 50. I don't know if it's going higher or lower. No one knows. But I do know I'm going to be watching it like a hawk, because if I get a Bible gap up, if I get a pocket pivot, I get a kahuna sitting on the 50-yard line support, I'm going to go long this stock. So I'm watching NVIDIA. My pullbacks waiting for signal are all similar to this. Assured guarantee. It hasn't really pulled back much, but it looks like it's pulling back here. It had a down day, a low close doji. I'm just going to put on a watch list and look for a kahuna or a pocket pivot to come in. And then lastly, my special situations, which are crappy charts that pay dividends like this of 11.1%. Here's one that got clobbered down to support. It's held here, it's held here, it's held here. And oh, by the way, it pays a 15.5% dividend. So that's how I do the weekend. And then I take those stocks, I go into TradeStation, and I have my radar screen, and I put those buys in. I'm looking for new HCDs and LCDs. I'm looking for PPS signals. If it's flashing, that means the last current market day, so Friday, was a new signal. If it's solid, it means the signal was in on Thursday or before. I can look at multiple time frames. I can go out here, and I can be looking for when are the earnings? Did I get a Bible gap up? And so I know right away if I got a Bible gap up, Aristonet. I want to look at Russ in a second. This is my, John Person calls it a Mexico trade. I'll explain that in a few seconds. But I'm interested in Russ or Russell, and I'll talk about it in a few minutes. I'm also scanning the day for pocket pivots. Up. Shouldn't see many down on my buys, but on the, these are the two. There's one of these was one that blew up that had the big rate. I might be looking for mobile breakouts from a squeeze. Those are breakdowns. I don't see any in my buys, but I do see some new mobile breakouts. So for example, without looking at the chart, here are 4 stocks that had they're in a squeeze. They had a mobile breakout from the squeeze and a pocket pivot, the last 2. So something tells me that it might be interesting to look at Trinity. So let's go in here. I bet it's in my buy watch list and probably a pullback ready to run. Let's see. Is it in here? Here it is. And here I have a stock, sloppy. It's not tight, but pullback, then an uptrend. Now it's sitting there on the 200, but it's also sitting on the 50-day moving average in a squeeze with a pocket pivot and a kahuna. So that meets my criteria as well. So I use my scanner, or a radar screen in this case, during the day. At night, I use my scanner here, and I'm able to scan for various signals to help build my watch list. Now, if you're a thinker swimmer, I might want to scan for example, let's look for I'm going to look for PPS buy signals daily in a squeeze. And these would be at the close on Friday. This is all standard scans built into thinkorswim. And it shows me CSX. That's interesting. Now you'll notice up here things that you probably don't have. I've built indicators for kahunas, which you may have if you're an HGSIer. This is a institutional buy-sell indicator, HCDs and LCDs, pocket pivots and Bible gap-ups, and most importantly, earnings date. So here I have CSX. Shows up on my PPS buy signals in a squeeze. One of the problems is that PPSs are one of my favorites to look for, but if I go into HGSI, I don't have PPSs, but let's put CSX here. This is how I use my scans. Is this a buyable stock? You tell me. I have big uptrend, sideways, sitting on the 17-day, pocket pivot, kahuna, earnings are out, small dividend, higher risk. I want to buy it here. Not this day, but I want to be looking for it here, and then if Bible gapped up here, this is a day you would have bought. I want to be looking for it here, down at the 50, coming off. Hard for me to buy stocks up here. I think the risk of failure is higher, but we are in a raging bull right now, and you might want to chase. And it is in a squeeze, at least by the definition of thinkorswim. You can look at the designer view or this one, has a thing called smart groups. So I could look intraday, end of day, under my name, find stocks that are pulling back to the 50 and have a kahuna. All right, we're going to ignore the first two, but we just looked at Square. Okay, let's just look at the others real quick. Just because they show up in a scan doesn't mean you want to buy them. You want to look at them. So Archer Daniels Midland's been going sideways. It had a couple kahunas come in, mobile breakout from a squeeze. Weekly bond goes red. It goes on a watch list looking for a break above the 50. Mitel Networks, kind of boring, but maybe getting ready to break out because it had the kahuna and a mobile breakout from a squeeze. I wouldn't touch this until it took out the PSAR dot, which is a long way, doesn't have any earnings growth. Square, we just said we liked. Enzo Biochemistry, another one of these small biotechs, in this case, or healthcare services. Couple of kahunas right below PSAR dot. So I don't like the pattern, but I'm going to talk about the close PSAR dot in a second. Sometimes I get a lot, sometimes I don't. Let's look at this one here. So let's look at what it says. Squeezing, potential PSAR reversal to the upside. So when I set this scan up, and it's updated automatically for you, I'm trying to find stocks that are squeezing. So that means they're going sideways, that are not extended, where the PSAR dot is immediately on top of them. So a move through that PSAR dot might stimulate people to start buying the stocks. Let's see what we find here, if anything looks good. I'm just going to point out the pattern. Are we squeezing? The yellow mustard, yes. Okay. Uptrend, squeezing, that's good. Had a pocket pivot, that's interesting. We're right below the PSAR dot. So let's say you wanted to buy Time Warner. You get on an airplane and you can't watch it intraday. So how do I trade, Jeff? Simple. This is actually, I don't see enough energy here for me to get excited. But let me talk about how I would manage this and on my get on a plane trading plan. So if I wanted to buy Time Warner, I would put a buy stop right above that PSAR dot. Now we know that PSAR dot is at 97.23. So I put my buy stop at 97.25. Then I look at this and I see it's got this 50-day moving average at support. It's not that far away. it hasn't gone below it. 1, 2, 3, 4, 5, 6, 7, 8, 9. Hasn't gone below the 50-day moving average since it touched here. So I know that's a safe place to put a stop. The 50-day moving average is at 95.63. So I'll just put my stop, say, at 95.60. And I put my buy order in. So my buy order says, go long Time Warner if it trades at or above 97.25. As soon as I fill, I put an immediate sell stop in at 95.65. So 97.25, 95.65, looks my math, I'm risking it less than about 2%, less than 2%. This is a medium likelihood of success because it's been going sideways for a while. I don't see a lot of momentum. But if I saw a kahuna on Monday and it took out that PSAR, I'd be all over this. I can set up my trade, my position size. I've got my stop in play. I can buy a lot of this because I'm only risking less than $2 or less than 2% per share. And the reason why I like this setup is the stocks are basing. My stops are usually able to be put very close to my buy price, so I'm at little risk, and I have a very well-defined buy. What happens if the market opens up 300 points on Monday? You won't be filled. Sorry, it's going to gap against you. What happens if the market opens 300 down on Monday, or Tuesday in this case? You won't be filled. It won't hurt you. So the market has to move up for you to get filled. The stock has to move up for you to get filled. That's good. What else is here? Harmony International, that's a takeout. Micro Semi, interesting. Sideways in a strong group, right below the PSAR dot. I don't like all the red. I'd probably pass. Town Bank. I bought VLY on this setup a week ago and actually made money even though the banks were quiet this past week. Uptrend, sideways. I could set the same setup here. First Financial. You can find a lot of banks are doing that. Here's a renewable energy, a train. Interesting. Uptrend, sideways in a squeeze, had a pocket pivot right below. Now what I might want to do, let's make it a little bit more interesting. What I might want to do is go into my, I'm not going to do that. I was going to filter these by kahunas. Now, one thing I could do is I could go copy symbols, a text column. And now I'm going to go here, new text. I'm going to call it PSAR squeeze up. And I better open up my files. I'm going to put it in here. And what I can do a lot of cool things with this. Save. I could go into TradeStation and I could put it into a radar screen. If anybody's even left, I've been talking a long time. It's time to stop, Jeff. Time to stop. And I could just, we'll call it test. And I just paste them in there. And then I can monitor during the day looking for pocket pivots. And I see some of them actually had a pocket pivot. Okay, that might be interesting to look at. I could look for viable gap ups. They're all giving me a mobile breakout, or several are giving me a mobile breakout from a squeeze. Even by a different technique, most of them are squeezing as well. So I take that list and I use it various different ways. All right, I think you're probably getting tired of my voice, so let me just summarize what we said today. We said that the market is in a very bullish trend right now. Those trends don't go on forever. We're getting very extended with several major indexes being above 95% on the high jump bar. So I'm a little bit nervous that we're getting to a point where we may have some risk. That said, it's hard to short a runaway train and be very careful. Now, I will take high reward, high risk trades. So let me show you my Russia thoughts before we go. Russia is an interesting place. It's very much tied to energy. And does this look like your oil stocks right now? I think it looks pretty strong. It looks like ever since we had an election where Mr. Trump won, we've gone from 60 to 105 on the Russian 3X bull long ETF. This is a fast mover, and this is a biggie. It had a very bearish reversal on Friday, dropped below the 50, mobile breakdown, negative pocket pivot, kahuna to the downside, coming out of the squeeze. So if I could look at the short RUSS, it's been in a horrendous, kind of reminds me of that TVIX from an hour and a half ago, horrendous downtrend. Okay, and as high as 276. Let's go back to the daily and now let's expand it a little bit. Oops, too much. What I want to show you is I had a mobile breakout from a squeeze and a kahuna and a PSAR reversal on Friday. So I'm looking for a contrarian play to the market, sort of as protection. I can look at the RUSS or the RUSL. So I'm looking at a couple of trades. One of the trades I'm looking at, and this is the kind of trade I like to take, you just put your own numbers, and this is contracts, not shares. Each contract is 100 shares rather. This is when I do my meetings, I call this my chicken shit synthetic. The stock price will go up or down based upon the price. And this blue line where my arrowhead is the performance of a long position in RUSS. When the price goes up, it becomes worth more money. When the price goes down, it's worth less money. This, when you do a vertical, which means I'm selling a put and then buying a put down here, I'm limiting my risk. So what I sometimes will do to buy long an instrument, and here I'm going long the bearish instrument, I might buy an instrument that goes to the upside, sell the same instrument to the downside, and if I just do the first two parts, I'm going to end up paying about 3 cents per 100 shares to have the same risk return if I bought the stock. If that stock goes from 6 to 10, then that means for each contract I'm going to go up $4 or $400. If it goes from 6 to 5, I'm going to lose $100 for every contract. Just like I had 100 shares, I lose $100. The benefit of the option play here is I'm getting in not for $6 a share, I'm getting in for 3 cents a share. The downside is there's a duration of time before that option expires, and I might make the mistake of going in too large and losing my shirt. So the way I protect my shirt is I buy something here which is costing me probably in the 10 to 15 cents range. It's 9 cents. And that 9 cents per 100 shares, or $900 per contract, or $9 per contract, that 9 cents is going to limit my downside to $1. So what I've designed here is an instrument that for this is for 10,000 shares or 100 options. Let's just go down to one option. Let's go down to 10 contracts or 1,000 shares, because that's probably more what people would do. Doesn't change anything here. So it's going to cost me to buy the upside and downside of 1,000 shares through options, limiting my risk here. It's going to cost, I'm going to get paid it's going to cost me $115 to control 1,000 shares until March 17th. 1,000 shares to buy would cost $6,000. So I'm controlling 1,000 shares for $115. If I'm right and Russia falls, then this Russian bear ETF may move to 7, 8, 9. Let's say it moves 1 to 7.25. As long as it moves there before expiration, for my $115 that I'm paying, I'm going to win $1,091. Turns out I don't know how high it can go, and I have an infinite profitability. On the same token, if it drops, say it drops just 57 cents down to $5.50, I'm going to lose about $700 or $640. So not only did I pay $115 in, I'm going to lose another $616. I don't like that either. If it dropped to 4, I'd be in big risk. But what I did here is I bought that protective put, so the most I can lose. So I'm looking at a trade that I'm paying $115 to get in, controlling 1,000 shares. The most I could lose is $1,115. Actually, that includes my $115 investment. So I'm controlling 1,000 shares. The most I could lose is $1,115, and my potential profit is infinite. And my break even, it just has to move from 605, where it's at today or 607. It's just got to move a nickel, and I break even. So I ask you, is this a risky trade? It's a risky trade if you buy too many positions. It's a risky trade if you can't afford this loss. But, you know, if I put on an 8% stop loss on a $6 play, it's about 50 cents. I'm only risking $1 here. And I have very little out of pocket. If it gaps down to 3 because Putin and Trump signed some new military deal, I'm making that up, and all of a sudden the short position in Russia disappears, the most I lost was $1. So that's why the options is nice. I've limited my loss. Big upside gain. I'm looking at this trade. I'm also looking at doing the opposite trade, which would be shorting the long, but for another day. Talk forever. I'm tired. You're tired. Listen to me. Have a great week. Be careful. It's been a strong market. I just don't know when that's going to stop. Neither do you. Just to remind you, Greg Mills meeting March 25th to 27th. Contact Greg at gam72054@aol.com. If you are going to that meeting, or if not, and you'd like to do a pre-meeting with me on the 24th and 25th, I'm not asking for money. I'm asking for interest. HGSIdoc@gmail.com. And then John Person's live meeting May 18th to 20th. If you email me, I can get you some more information. You all have an outstanding week. Trade safe, not often, and we'll see you next week.